Even the best investments of all time have bad months, sometimes even bad years, and can be negatively impacted by things outside of your control, external circumstances. Fortunately, though, we live in a day and age where the sophistication of our financial markets and our technology allows us choices to hedge and protect our assets from those crashes, from those things we cannot control. Now, many people just assume that these sort of protection strategies only apply to big money, are only available to the rich, or maybe even are only available to publicly traded equities or ETFs. But in this video, I'm going to show you how you can hedge literally any asset that you own. You can protect it from a crash, even if it's something like real estate or gold. And if you don't know who I am, my name is Joe Brown. In 2019, I quit my job as a stockbroker, and now I run Heresy Financial University, where I teach how markets work so that you can make more money investing. So first we have to look at what actually is a hedge. Well, Oxford Dictionary says that it is a fence or a boundary formed by closely growing bushes or rectangular shrubs. Wrong hedge. There are two basic ways a hedge can work from an investment perspective, and the first way is that it stops you from experiencing a loss on your investment by allowing you to sell your investment before the price drop happens. For example, a hedge on Bitcoin in this way would have allowed you to exit Bitcoin around the $60,000 mark in November of 2021. And then after the crash, you would have had as much cash as you needed in order to get back in whenever you wanted. So that is one type of hedge. There's a second type of hedge though, that allows you to stop yourself from experiencing the loss when the price of your asset drops by owning something else that makes the same amount of money as you lost on your asset. Going back to the Bitcoin example, instead of selling Bitcoin around 60,000 right before the crash, you hold on to Bitcoin and you watch $30,000 worth of your Bitcoin disappear, while at the same time you own something else, a hedge, that grows by the exact same amount. So on one hand, you lose $30,000 on the Bitcoin that you own, and on the other hand, you make $30,000 from your hedge. You break even. Now that we understand what a hedge is, it highlights two things about hedging. Number one, hedging itself doesn't make you money. It just stops you from losing money. Now, that doesn't mean it's not important. In fact, stopping yourself from experiencing losses is one of the most powerful tools you can add to your investment tool belt. If we look back at the Bitcoin example, when Bitcoin went from 60,000 down to 30,000 and then back up to 60,000, you're just at break even if you're just buying and holding. But if you have the ability to hedge, that means that when it goes down from 60,000 to 30,000, you still have $60,000. You're able to reinvest it at the bottom, and when it comes back up to 60,000, you now have twice the amount of Bitcoin than you did before. Hedging is an extremely powerful wealth building tool over the long term that makes you more money in the long term. It's just the hedge itself doesn't make you money. The second thing to note is that there is no such thing as a perfect hedge. And actually, the closer you get to your hedges being perfect, meaning they're going to cover 100% of your losses perfectly, the more expensive that hedge will be, the higher it will cost. You're going to have to factor that cost into your calculations, which means that that actually takes away from it hedging your investment perfectly. So when we're trying to protect our assets from loss, we're not trying to do this 100% perfectly. We're not trying to have perfect hedges. We're just trying to get close. All right, you've graduated from Hedging 101. Now let's take a look at the application, the things you can actually do to hedge your investments. The first thing that we're gonna do is never have big losses. And pause right here, because I know you're probably thinking, well, you're just saying if you want to hedge, never have big losses. But trust me, we're gonna go into the details. You're gonna understand what I mean here. There are only 5 outcomes that are possible with an investment. Number 1, you make a lot of money, big profit. Number 2, you make a little bit, just a small profit. Number 3, nothing happens. It just moves sideways, no profit, no loss. Number 4, you have a little loss. It goes down a little bit. Number 5, worst case scenario, you lose a lot. You have a big loss. Here's how most people approach this. Most people look at their portfolios and they have some big losses, some big wins, some little wins. And they're looking at their big losses and they're thinking, man, I have to hold on to this until it comes back to break even so I can sell without actually taking a loss. Because as long as I don't sell, I haven't actually taken a loss yet. And because of the few big losses that they have, they get scared of experiencing that same pain of loss in the future. So they look at all of their other investments, and anytime something has a little bit of a gain, they think, man, I'm going to take that profit. Nobody ever went broke from taking a gain. And so they sell. So this leaves the average investor with no big wins because they stop themselves from ever being able to experience a big win by selling anything by the time it becomes a little win. It also leaves them with little losses and some big losses, which means that overall, the big losses are driving their overall portfolio performance. And this is why most people throw in the towel investing and think it just doesn't work for them. And instead, you need to be doing the exact opposite. Your little profits and your little losses will cancel each other out. You'll break even between those two categories. But if the only thing you do in your portfolio is stop yourself from ever having a big loss in your account, that means your big profits will drive your overall portfolio performance. It'll be the only thing left having an impact on your overall portfolio. Now, that might sound like another duh statement. Sounds great in idea. How do you actually do that in practice? And the reality is you have to recognize that there is never a big loss that didn't first start off as a small loss. In other words, every big grown-up adult big loss started off as a baby loss. And if you kill all of your losses while they're still babies, they will never have a chance to grow up into adult big losses. In other words, you have to fall in love with taking small losses. And this is one of the things that almost every one of the greatest investors and traders throughout history learns at some point. The good news is, though, there are tons of ways to actually go about doing this. The first way is simply paying attention. If you have a job that allows you to sit there and you can look at your investments, you can look at your portfolio and you can see, hey, this one just turned into a small loss. I'm just going to go in and sell it because if I hold on to it, it might come back and turn into a winner, but it might turn into a big loss. And the big loss is the thing that we're trying to avoid because that's what's going to crush our performance over the long term. And so anytime something turns into a small loss, me just paying attention, I will see it and I can sell it. Now, obviously this doesn't work for more illiquid things that are harder to sell. This is going to be harder to do with like physical gold, very hard to do with real estate. We're going to get to that. Don't worry. The second way you can do this is with alerts. If you don't have the ability to just be refreshing your portfolio page all day, every day, and you don't want to, quite honestly, you can simply set up alerts. With any of the major online stock brokerages today, you can go in and you can set an alert that says, hey, if this goes down by 1%, 5%, 10%, whatever you set as your maximum acceptable loss on that position, send me an alert, send me a notification, send me an email, and then you have the chance to go in and sell. Another way you can do this is with some very simple technical analysis. You can look at something as simple as price action below a 200-day simple moving average or breakouts from prior support or resistance. Doing it this way will allow you to apply a little bit more objectivity and a little bit more discipline into your trading or investing strategy rather than relying on emotion, because let's be honest, when you see red on the screen, the last thing you want to do is say, okay, I accept it. So putting in a little bit more objectivity through something like technical analysis is going to allow you to stay more disciplined to your strategy. Let's say you're a value investor though, and you hate looking at charts because you're a disciple of Warren Buffett. Well, I'm going to tell you the Warren Buffett method of trading. Even though it's on a longer time horizon, he still does have exit plans. It's just through a different disciplined approach. And that's by looking at the fundamentals. And you can do this too. Warren Buffett has talked repeatedly about ideally when he buys a company, he thinks I'm going to own this company forever. And so when I buy a company, I want to make sure I'm buying a really, really good company that I can trust that I'm going to hold forever. But in reality, it doesn't always turn out that way. And sometimes companies change. Sometimes leadership changes. Sometimes the economic environment changes. There's a reason why over the last couple of years, he's completely gotten out of all of his bank stocks. It's just not a good business for him to be in anymore. And so if you are buying companies or assets based on the fundamentals, the financial statements, the cash flow, the debt to income ratio, the price to book ratio, price to earnings, then you also need to be selling those companies based on those same factors. If the fundamentals change, the investment is no longer a good investment. And the nice thing about this is more often than not, the fundamentals will change before the market recognizes that the company has changed. Many times, the objective financial metrics will deteriorate and the price of the company will still be going up. And the market may not realize that I was right for a year or 2 years or longer, but I know that I only invest in companies based on these certain circumstances, these factors. And so if those fundamentals change, then my investment changes as well. So those are all the ways to cut your losses based on paying close attention in different disciplined ways. But if you simply don't have the ability to pay attention, there's another way you can do this. And this is simply with different order types. That's right. You can just automate yourself getting out of an investment through setting up orders. There are two types of order categories you can use when you are buying or selling a security, and that is a market order or a limit order. A market order simply says, I want to buy it or I want to sell it regardless of what the price is. Just get me next in line. I'm going to buy or sell. Now, for almost every single publicly traded stock and ETF today, that is a perfectly acceptable way to trade because there's so much volume going on that whatever price you see on the screen is pretty close to the price you're going to get if you do a market order. But there are some financial securities today that are not as liquid as that, which means you need to use a limit order, which means you say, I want to buy this or I want to sell this, but only if I can get a specific price for it. And if there's nobody else out there willing to match me on that price, then I don't want to actually buy or sell it. So those are the two order categories, market orders and limit orders. Market orders guarantee execution, but they don't guarantee price. Limit orders guarantee price, but they don't guarantee execution. So how can we use these to hedge our investments? The first one of these is a type of market order called a stop order. Let's say you have an investment in SPY, the S&P 500 ETF, and you want to sell it if it starts to drop. Let's say specifically you want to sell it if it drops to $518 per share or farther. You will simply set up a stop order at $518. That is an order that sits with your broker that if SPY does come down and trade at $518, your order will fire off and it will sell your shares at whatever the next available price is. Again, market orders, this is a type of market order, can guarantee execution but not price. And so once SPY hits $518, it will fire off your sell order for you at market and you will get the next available price, which could be above $518 or it might be below $518. Now you might think, well, that's a terrible idea because what happens if the S&P 500 gaps down overnight? Let's say it's up at 519 today and then tomorrow morning when it opens up, it's down at 510. Then my order would fire off and I would get filled at 510. And you're absolutely right. Remember, with an order, we can either guarantee execution or we can guarantee price. The market order, we're guaranteeing we get out. We have no control over what price we get out at. And that brings us to our next order type, which is kind of a Frankenstein mashed together. It's called a stop limit order. Let's say we still want to get out at 518. We would set up a stop limit order so that if SPY does start to drop and hits 518, our order fires off. So how does this order work? Well, we have to actually choose two prices here. We have to choose a stop price and we have to choose a limit price. The stop price, just like before, is the price at which our order goes live. In our first example, our order goes live when SPY hits 518. So in this current example, we'll also say our order goes live when it hits 518. So our stop price to sell SPY is 518. But in this case, we have to choose a second price as well because this is not a stop market order. Now we're doing a stop limit order. So we have to choose a limit price in which we are saying we only want to sell if we can get a specific price or better. So let's say 516 is our limit price. That provides a little bit of protection for us because we're saying, hey, if SPY comes down to 518, I want to sell, but I only want to sell it if I can get at least 516 for it. If SPY opens up tomorrow down at 510 or 500 or lower, I don't actually want to sell. I'll just hold on. So again, a stop limit order is a combination where we have to choose a stop price, in this case 518, which is when our order goes live. That means if SPY drops to 518, our order goes live. The order itself is a limit order to sell the shares at 516 or better, which means we'll only sell if we can get out at $516 or higher. Now this order as well comes with its own trade-offs because If SPY gaps down, then you don't actually get out. And so now you're sitting on a bigger loss. But it does provide some protection against a flash crash, like has happened recently, where the stock price goes down really fast and then comes right back up. It provides you some protection from getting sucked into something like that, selling really low and then having the price be way back up where it was before. Now, there's a third order type that we're going to look at here. I think this is the most fun one, and it provides you the most protection against losing gains that you've already accumulated. So using the SPY example, we know that right now SPY is trading up around $530, but let's rewind the clock and say that SPY is still trading around $450. Let's say this is where we buy around $450 and SPY just starts going higher and higher and higher. This is where a trailing stop order will come in really handy. A trailing stop order is very similar to the order we talked about first, which was the stop market order. Essentially, if the stock falls down a certain amount, then it will fire off a market order to sell. The cool thing about the trailing stop though, is the price at which that sale is triggered continues to rise with the stock. Once the stock starts to fall, it stops moving and it'll trigger. So in our example, let's say we bought SPY at $450 and we wanted to sell if the stock price ever dropped by $10 per share. Well, a little while later, the stock price is up at $476, which means that our stop order rises to $466. You can think of it kind of like a ratchet, where a ratchet can only move in one direction, but not the other way. A trailing stop order will go up with the stock, but it will not go back down when the stock starts to drop, which means the most you could ever lose at any given time is the amount that you set the stop to follow by. So whether you want to set your trailing stop at a percentage like 1 or 2 or 5 or 10% or a dollar amount, it's either way, it'll follow it up and you can go up an unlimited amount, but the most it could ever fall before triggering your order will be the exact amount you set. In something like the SPY example that we're looking at, this sell order would have traveled up and up and up, and then probably would have been triggered somewhere around the $510 mark when SPY started to drop in April of 2024. Now, I know what you're thinking. Those are some great ways to protect yourself from losses on publicly traded equities for no cost, but there's some trade-offs. You either guarantee execution or you guarantee price, or maybe you have to pay close attention. If you have none of those options available to you, or if you are invested in things that are not publicly traded stocks, are you out of luck? No, you're not. This is where options come in, derivatives. Now, there's always a trade-off, remember? Because you think the word options or derivatives and instantly you think, complicated or, high risk. And fair enough. Stick with the order types or paying attention, technical analysis, some of the other things that we talked about. But if you want more choices, or in other words, if you want more tools in your tool belt, this is where it comes in. Now in this section, we're going to be focusing exclusively on one type of option called a put. But first, what are options? An option is simply a contract that gives either the buyer or the seller either the right or the obligation to either buy or sell the stock. And if that sounds crazy to you, just imagine a piece of paper. This is a contract. And on this contract, it says it gives the buyer the right to buy a stock, or it says it gives the buyer the right to sell a stock. And then I can take this paper and I can sell it to somebody. This is a very useful tool because it means that I, as a buyer of a put option, I'm paying somebody else for the right to be able to sell them my assets at any time between now and expiration at an agreed upon price. They're okay with this because I'm literally paying them to take on this obligation, and I'm okay with this because it gives me an exit from the asset if I want it. Now, obviously you can use puts on individual stocks or index funds like ETFs, and that is perfectly fine. But in this section, we're gonna focus on how you can actually use puts to protect your assets that are not publicly traded stocks. And first, we're gonna look at an example of how you can do this, not a recommendation, just an example of how you can do this with real estate. Because let's say you do have a couple rental properties that are individual single family homes. You're looking around and maybe you're in a market that might not be the best in the United States right now. And you're thinking, man, it's cash flowing right now. I've got a good interest rate on my mortgage, but people are talking about a crash. I'm concerned. What should I do? Should I just sell? And then I'm hoping that there's going to be a crash so I can buy cheaper later. How can I hedge myself against a loss on these properties? Nobody's going to take a contract. Like, I'm not going to be able to pay somebody to buy this property from me if the real estate market crashes, right? And you're absolutely correct. And this is why I said earlier that not all hedges are perfect and they don't have to be perfect. Here we're gonna get a close approximation that's gonna get you 85% of the way there. This right here is a company called Invitation Homes. The symbol is INVH. They own about, 90,000 single family homes across the United States. They are a real estate investment trust. They own these homes, they buy them, they fix them up a little bit, and then they put a tenant in that house. Essentially, they're just a giant landlord, which means if something devastating happens to the single family homes across America and there's a big real estate crash, a company like Invitation Homes is probably going to be fairly negatively impacted. And guess what? You can buy puts on Invitation Homes. If your rental property portfolio is worth $1 million and you want to hedge against a 50% crash in the real estate market, then you can go into Invitation Homes, you can look at that time period in which those options contracts exist, and you can buy 1 or 2 or 5 or 10 contracts that add up so that you are hedging your proper portfolio size, so that if there's a 50% drop in the real estate market, then the increase in the value of the puts you buy on Invitation Homes will make up for the amount of money you've lost on paper with your properties. And then guess what? You still own your properties, but now you have that extra cash. You can either use that to supplement income, you can use that to sell your properties at a discount, but now you break even because you made money on the puts. You have all sort of options available to you now. This is why it's so important to recognize that hedges don't have to be perfect. They don't have to be exact. They just have to be a close approximation to making you the same amount of money that you are losing over the same time period. And that way it can act as a hedge. That allows you to get creative and hedge something that you don't technically own, like you can buy puts on Invitation Homes in order to somewhat hedge your real estate portfolio. And you can do this with any asset. Let's say, for example, number 2, you own some physical gold and it's in storage in a vault in Switzerland. You're not going to be able to pay Brinks any amount of money and say, hey, if gold drops by 30%, I want you to buy these ounces from me at $2,300 an ounce. However, you can look up the ETF GLD, which is the largest and most liquid fund that owns gold, and you can buy puts on GLD. And if you have $200,000 worth of gold and you're concerned about a 50% crash, that means you would lose $100,000 if there's a 50% crash. So you look at the option chains for GLD and then you buy the correct number of contracts that will make you $100,000 in profit if GLD falls by 50%. Same thing with Bitcoin. Let's say you're concerned that Bitcoin is going to crash by 80% or more. It's very difficult to directly hedge your Bitcoin, but you can do something very similar and potentially even more powerful by simply buying puts on something like MicroStrategy, a company that its performance is directly tied to Bitcoin, which means that if Bitcoin falls, MicroStrategy will probably fall even more. And guys, I hope you understand that these are simply examples to get your creative juices flowing and allow you to see that no matter what investments you have, no matter what assets you have, no matter where they're held or how illiquid they are, there's always a way that you can protect your investments. And I hope you see the power in this as well, because if an investment that you own falls in price, you're just out of luck and you have to wait until it comes back or actually take the loss and go try and move on to another investment that's going to have to do 2 or 3 times as much just to get you back to break even where you were before. But if you learn the discipline and use the tools that allow you to stop yourself from ever experiencing these very large losses, number 1, you never have to worry about those large drawdowns. Number 2, on the way back up for those asset prices, you're now investing way more money. It's the most powerful wealth building tool there is, stopping yourself from having large losses. There are unlimited number of ways to do this and tools that you can use to hedge your account. But the thing is, you actually have to do it, and you have to do it before the crash actually happens. Otherwise, it's too late. And if you want me to help you apply strategies like this to your specific portfolio and your investing, work with me, join Heresy Financial University. Link is in the description below. As always, thanks for watching. Have a great day.